What's up everybody, Nate here, and Americans all throughout the United States have been facing the harsh effects from inflation for the last year and a half or so. Now, I'm sure I don't have to point you to a chart or a graph to tell you how bad inflation has gotten in our economy, but if I did, then I'd point you to the Consumer Price Index. The Consumer Price Index basically is a basket of goods and services in the United States, and it shows us how the prices for those goods and services are going up or going down every single year. Now, that index has gone up year over year by around 8.3%, a near 40-year high. However, when we talk about inflation and how our country battles inflation, that comes down to the Federal Reserve, and the Federal Reserve has a little bit of a different way of looking at inflation. They go off of a few different numbers and not the Consumer Price Index or the CPI numbers. Even still, the Personal Consumption Expenditure Index went up way more than expected in August, which means even though the Federal Reserve has been raising interest rates, we are still having a huge problem with inflation. Now, this is something that you definitely want to pay attention to, because as the Federal Reserve continues to see inflation going way up in our economy, that means that they're going to have to make some adjustments with their monetary policy. That's going to affect the stock market, which means your investments, and it could mean your retirement savings. It's also going to affect businesses, and it's going to affect employment all throughout the United States. So we need to pay attention to these numbers to kind of figure out what the Federal Reserve is going to do next, because they have a huge impact on if our economy is going to be strong or extremely weak over the next year or two. So today I want to talk about the Personal Consumption Expenditure Index. I want to go over what numbers actually went way up, what exactly this means for the Federal Reserve and Americans, and what we can expect to see from both of those entities in the future. From now on, I'm just going to call it the PCE numbers. That again stands for Personal Consumption Expenditures, and that number overall actually rose by around 0.6% in the United States. This is essentially a number that is very closely related to the CPI numbers. So the CPI numbers show what prices are actually going up in the United States, and the PCE numbers actually show us what consumers are spending their money on. So we have prices on the shelves, and then people actually buy those things. That's what the PCE numbers show us. We're starting to see right now more and more Americans spending more of their income on things like food and energy and travel and shelter in the United States. And that is pretty easy to see why, because everything right now is going up in price. The amount that Americans actually spent on housing and utility costs went up by around 1% in August, and food actually went up by 0.8%. Only thing that really went down was energy costs, and that was directly linked to gasoline costs. But overall, the PCE numbers actually went up by around 4.9% year over year. So on average, Americans are spending around 4 to 5% of their income more on just about everything than they were a year ago. Now, why do these numbers actually matter? Well, like I said before, the CPI is very general. That is a basket of pretty much all major goods and services in the United States, but Americans, for the most part, are not buying all goods and services in the United States. They're only buying certain things. So when the prices go up for some things, yeah, that sucks for some individuals, but not everybody is purchasing those things. But there's a lot of other things in the United States, like food and shelter and utilities, that most Americans are going to be spending their money on every single month. So the Federal Reserve likes to look at these numbers rather than the overall inflation numbers to try to figure out if inflation is actually rising. If Americans are starting to spend a lot more of their paychecks on certain things, like I said, food, shelter, and utilities, then that shows the Fed that inflation is a problem in our economy and they have to do something to bring it down. Now, that begs the question, what exactly is the Federal Reserve right now doing to our economy and, of course, inflation? We have had a lot of money printing. We have had a lot of supply chain issues. We've had basically a complete reshuffling of our entire labor market. All of those things means that we're going to have big changes in pay, we're going to have big changes in income, and we're going to have big changes in factors such as supply and demand in our economy. When you have a lot of demand for something, then prices are going to go up. And because of the pandemic, we had really low interest rates, which sparked demand, and we had lots of money printing to get us out of a really bad recession, and we didn't really know what was going to go on with the pandemic. So the Federal Reserve and the federal government wanted to get us out of that as quickly as possible, and the fastest and easiest way to do that is to just turn the money printer on, right? Just turn it on, print a whole bunch of money and send it out, because now people don't even have to work and they're going to be able to continue to keep up their same spending habits. But in that time, what you've got to understand is when you print a lot of money, you have to create some sort of value. You have to create some sort of wealth, or else you're going to have a lot of inflation. It's important to note here that the Federal Reserve and the federal government prints money every single year. Even pre-pandemic, they were printing trillions of dollars, and the reason for that is to grow our economy. They print the money and then they give that money to banks, or they give that money to private corporations or public companies, and then that money is redistributed throughout our entire economy. And that means people have more money to spend and put back into the economy, so everything grows. Businesses will hire more workers, companies will need more money so that they can expand, and everything starts to grow. So you do need to print a little bit of money every so often. If you kept the exact same supply, well, then everybody would have exactly the same, but we have an expanding economy with expanding needs, so you're gonna need more money at some point. But the big key there is when you print money, that money goes back into something. Something is created from that. But the federal government over the last 2 years printed a lot of money, but they didn't really create anything. Sure, people were able to go out and buy things, but the businesses weren't really able to create anything beyond that. So now businesses were just stuck with producing more, even though they weren't given that money to actually produce more. People started to buy a little bit more than what they actually needed, and that was a serious problem all throughout our economy. Now, I will say there was a lot of money that was spent that people absolutely did need, but it was on top of nobody working during the pandemic, so none of that real value was actually created. And that led to a lot of inflation, and this is exactly where the Federal Reserve comes in today, because 2 years ago, the Federal Reserve really helped to spark a lot of those inflationary problems by printing a lot of money and lowering their interest rates. With their interest rates really low, it was easy for people to invest in a business. It was easy for people to take on debt on an auto loan or a mortgage, or they could go out and get a new credit card, spend on an existing credit card. It was really easy to spend money because interest rates were so low. You were going to save a lot of money on those purchases. Now, though, in 2022, the complete opposite is going on. The Federal Reserve wants to lower and remove all of that demand now. They don't want to make it as easy for people to go out and spend money, so they are raising their interest rates. And that means we are going to see the exact opposite of what happened over the last couple of years at the end of 2022 and beyond. Because we're still seeing so many Americans spending a large portion of their paychecks on certain things, that means the Federal Reserve is going to have to continue to get aggressive with their interest rate policies and continue to raise them for pretty much the next year or two. That means our entire economy is going to slow down, because like I said before, what raising their interest rates means is a lot less demand for everything. Mainly, people are not going to be able to invest in businesses or take on debt and capital as easily as they could before, and businesses are really what drives our economic growth. Consumers drive our economy, which eventually drives growth for businesses, but we're not really seeing a whole lot of spending right now because inflation is super high and businesses are not making the same amount of profit as they did over the last couple of years. And the way that businesses grow is because of that investor liquidity. So if businesses are no longer receiving that capital and they're no longer receiving that investor money, well, now they're not making money from sales and they're not growing because of the lack of capital from investors. That means that they're going to have to shrink something in order to make a profit. Usually that starts with people, because it's really hard to cut the costs of other areas of your company. So they start with the people and they try to operate with as few of people as possible. Now, this is a particularly big issue in 2022 because in 2021, businesses were thriving and they were growing because of all of these easy money policies and all of the low interest rates in our economy. They were overhiring people like crazy and they were paying them whatever they wanted to, and people loved it because at the time inflation wasn't extremely high, so people not only got a bigger and better job, they were making a whole lot more money, and Americans typically go out and spend this money, whether it's on investments or whether it's just on things that they need or want. They go out and spend this money. Now, again, people need to spend money. There's nothing wrong with spending money, but we have also started to see debt go way, way up in the United States, and the problem we could run into in 2023 is that, well, the Federal Reserve is raising interest rates, businesses are going to have to start cutting people as a result, and that means that while all of this debt that people have racked up, somebody's going to have to pay it. Businesses and banks don't have the money, so you can do the math on the problem this is going to cause. Now, there's obviously no guarantee if that's going to happen exactly like that in the near to distant future, but what I mostly want to focus on for this video is, does the Federal Reserve actually have to raise interest rates in the United States? And this is a really interesting question. What is really causing the inflation in our economy right now? Well, yes, it has a lot to do with all of the money printing and the low interest rates, but even though interest rates have gone way up, even now above the neutral 2.5% mark, and the Federal Reserve has basically turned off the money printer, meaning they're not printing a whole lot of money, then why exactly do we still have inflation? Better yet, why is inflation not really coming down? It's slowed down, but it's not lowering in the United States. It's basically sitting around that 8% mark right now. When we talk about inflation, there's a lot of different ways that you can consider it. Inflation, by definition, is when the monetary supply of a country goes up, but there's also a lot of symptoms from inflation after you print that money. One of them is really high demand and prices rising in a country because now people have a lot more money. They go out and spend that money, and businesses have to pay people more as a result, and they have to pay more to produce more goods in order to meet that demand. So that is the major problem with having inflation. And now people just need more money all the time, and you can't just print your way out of all of these problems because your money is essentially going to be worthless at some point. But there's also a lot of other issues that can cause prices to go up in the United States. Obviously, price gouging is one from really greedy corporations that look at the situation in the United States and other countries and try to figure out a way to make a profit off of that. They try to make a profit off of our supply and demand needs, and also our fear over what's going to happen next in our geopolitical and just our universal lives. So that is one. And then you also have actual and legitimate supply chain concerns with things like China having pandemic lockdowns, the war between Russia and Ukraine causing gasoline and oil prices to go up. Whatever it may be, it's really expensive to get a lot of things right now. If you look at the housing market in particular, new builders are having a hard time selling homes because they're having a hard time building new homes. They can't get all of the materials that they need, and when they do, they have to raise the price so high on their home just to make a profit because all of the materials have gone way up. That is the supply and demand pull and push of inflation, and that could come up and go down in certain industries or certain times of the year for pretty much anything. However, that is something that could potentially go away, and that's why the Federal Reserve over the last couple of years has been saying that this inflation problem is transitory. Once we fix the supply chain problems, eventually we're going to not have that high of inflation anymore, but those things have continued to persist every single year, leading many people to believe that inflation is not transitory. And then you couple that with all of that money that's now been poured into our economy. All of that money is not going away. Enter the Federal Reserve. Now, the Federal Reserve does not control legislation. They do not control our supply chains, but they can control supply and demand in a certain light. They can raise their interest rates. They can lower their interest rates. That way it makes it impossible to spend money in our economy. That gives time for supply to eventually catch up, and it eventually brings down inflation because now people are basically barred from spending any money. And when you think about it, this is really all the Federal Reserve can do. The Federal Reserve, like I said, does not have control over legislation. They can only control our monetary policy. So they have to either raise interest rates or they have to lower them. They really can't lower interest rates in this environment because that's just going to make inflation go way up. In their eyes, they have to continue the course. And this is something that Chairman of the Federal Reserve, Jerome Powell, has talked a lot about. They're going to stay the course and continue to raise interest rates until inflation is down to that 2% mark. They don't really care what happens to the economy because they want to make sure that the inflation problem completely disappears because that is what they're in charge with doing. So they're going to raise their interest rates, and they're going to make it really difficult to spend money because if nobody's spending money, then prices for everything are going to come down in our economy. Again, that's going to have a lot of economic pain. Businesses are most likely going to have to fire people, meaning unemployment goes up, but the Federal Reserve is sort of looking for this to happen because if people don't have jobs, people can't spend money. Meaning inflation for everything eventually comes down because demand is is slowly starting to decrease in the United States. Now, why this is important is because every single month we have more and more indexes and reports coming out that things cost way more in our economy than they did a year ago, and Americans are spending more on everything right now. That means everything is getting pushed up, from wages to prices to production, for everything. And businesses right now have to be very careful with how they pay people, because they have to kind of keep an eye on inflation too, because if inflation continues to get out of control, and they're going to have to pay people more. But if inflation is starting to go down, then if they start to overpay people, now people have more money than they did before while inflation is lowering, which means they're going to buy a whole lot more, and eventually inflation will go back up. In the meantime, the Federal Reserve is looking at all of this, and remember, they don't have a direct control over food prices. They don't have direct control over shelter prices. Their goal is to make spending go down because businesses are not going to be able to expand as quickly. And every single month, these indexes go way, way up, which means the Federal Reserve is going to have to tighten and continue to restrict our economy for the foreseeable future, which means this pain that we're starting to feel could get a whole lot worse in 2023. They have to raise their interest rates until they really start having an effect on businesses and everything else in our economy, because they don't have control over prices in food and prices in shelter and prices in utilities. And like I said before, that could mean a lack of spending and of course lack of growth and a lot more unemployment in our economy in 2023 and beyond. And of course, that directly affects you and your money. Now, to be completely fair here, I don't have a crystal ball in front of me. I can't tell you exactly what is going to happen with our economy, and I can't tell you exactly what the Federal Reserve is going to do with their monetary policies. We don't really know. The Federal Reserve could look at our economy in 6 months and say, well, they're done raising interest rates. They've done enough, and if inflation comes down a little bit, then they could actually turn the money printer back on and stimulate our economy. I don't think they're going to do that, but it's definitely possible. That could mean we see everything go up again because the money printer's on, people are spending more money, companies have bigger profits, but eventually it's going to mean some pretty serious inflationary problems again. So this is all something to keep into consideration, and it's going to matter because you have to know how to spend your money right now. And keep this in mind, if the Federal Reserve does too much or too little, either way, that's going to break our economy. So right now, we're hoping that they somehow can make it right down the middle with their monetary policy. But now I want to hear from you on this issue. What do you think about the PC index, and what do you think the Federal Reserve is going to do next with their monetary policy? Do you think the Federal Reserve is going to hike us into a massive recession, or do you think eventually, sometime soon, they're going to flip that money printer back on and grow our economy, meanwhile making inflation get a whole lot worse? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.